We can't express how important our subscribers are to us. If you enjoyed this video, please subscribe, like, and share. Comment below where you're watching from and what kind of videos you'd like to see from American Northwest Magazine. Don't forget to click on the notification bell so you never miss an update. Also, consider turning on closed captioning to catch details you might miss by listening only. The 1920s were a time of unprecedented economic growth and prosperity in the United States. The stock market soared, consumer spending reached new heights, innovation flourished, bringing about transformative technologies like the radio and the automobile. Today, some economists believe we are on the cusp of a similar era, a new roaring 20s. Economic indicators are flashing green, unemployment is low, consumer confidence is high. But are these signs of genuine and lasting growth, or are we headed for a repeat of the excesses that led to the Great Depression? The parallels between the 1920s and today are certainly striking. Technological advancements, particularly in artificial intelligence and renewable energy, are poised to revolutionize industries and create new opportunities. The COVID-19 pandemic, while devastating in its impact, also unleashed a wave of pent-up demand and forced businesses to adapt and innovate. These factors, combined with accommodative monetary policy from the Federal Reserve, have created an environment ripe for economic expansion. UBS, the global financial services company, has been closely monitoring these trends, as highlighted in a recent article by Yahoo Finance.
One of the key drivers of economic growth is the availability of credit. When banks are lending freely and interest rates are low, businesses can borrow money to invest, expand, and hire more workers. This, in turn, leads to increased consumer spending, further fueling the economic engine. This cycle of credit expansion and contraction is known as the liquidity cycle, and it plays a crucial role in shaping economic booms and busts. Currently, the United States is in a period of relatively easy credit conditions. The Federal Reserve, in response to the COVID-19 pandemic, slashed interest rates to near zero and injected trillions of dollars into the financial system. This has made it easier for businesses and consumers to borrow money, contributing to the economic recovery. However, it has also raised concerns about inflation and asset bubbles. While access to credit is important, it is only one piece of the economic puzzle. For sustainable growth, an economy needs something more fundamental: productivity growth. Productivity refers to the amount of output produced per unit of input, such as labor or capital. When productivity rises, businesses can produce more goods and services with the same amount of resources, leading to higher wages, lower prices, and a higher standard of living. Historically, the United States has been a leader in productivity growth, driven by factors such as technological innovation, a skilled workforce, and a favorable business environment. However, in recent decades, productivity growth has slowed, raising concerns about the long-term health of the U.S. economy. Some economists argue that this slowdown is a temporary blip, while others believe it reflects deeper structural issues.
Section 4, Buffett's Moves, a Sign of Caution. Even as some investors embrace the possibility of a new roaring 20s, others are sounding notes of caution. One such voice is that of Warren Buffett, the legendary investor and CEO of Berkshire Hathaway. Buffett, known for his long-term investment horizon and aversion to market speculation, has recently made headlines for selling off significant stakes in tech giants Apple and Microsoft. Buffett's moves have been interpreted by some as a sign that the Oracle of Omaha sees trouble ahead for the stock market, particularly in the tech sector. However, it is important to note that Buffett has a long history of making contrarian bets, often buying when others are selling and vice versa. His recent trades could simply reflect his assessment of the valuations of specific companies rather than a broader bearish outlook on the market.
Section 5. The Federal Reserve's Balancing Act. The Federal Reserve, as the central bank of the United States, plays a crucial role in managing the economy. It has two main mandates: to maintain price stability, keeping inflation under control, and to promote maximum employment. These two goals can sometimes be at odds, forcing the Fed to strike a delicate balance. In recent years, the Fed has faced the challenge of rising inflation, fueled in part by supply chain disruptions and strong consumer demand. To combat inflation, the Fed has embarked on a series of interest rate hikes, making it more expensive to borrow money. The goal is to cool down the economy, and bring inflation back down to the Fed's target rate of 2%. However, raising interest rates too quickly could trigger a recession. Section 6. A boom or bubble, weighing the possibilities. So, is the U.S. economy on the verge of another roaring 20s? The answer, like most things in economics, is complex and uncertain. There are certainly reasons for optimism. The economy is strong, unemployment is low, and innovation is thriving. However, there are also potential risks, including inflation, rising interest rates, and geopolitical uncertainty. Ultimately, the trajectory of the economy will depend on a multitude of factors, many of which are difficult to predict. The Federal Reserve's ability to navigate the current economic environment, the pace of technological innovation, and the behavior of consumers and businesses will all play a role in shaping the years to come. Whether we experience a sustained boom or a painful bust remains to be seen.
What do you think? Are we headed for another roaring 20s, or are we on the brink of something else entirely? Share your thoughts in the comments below on where you're watching this video from and what kind of videos you'd like to see from American Northwest Magazine. And don't forget to like, subscribe, and share this video with your friends. Click on the notification bell to stay updated. Your support means the world to us. Thank you for being such an important part of our community.